Picture this scenario. Sarah, a 34-year-old marketing manager, did everything right with her investments. She read all the books, listened to all the podcasts, and followed all the conventional wisdom. She put 80% of her retirement savings into a simple S&P 500 index fund because, as everyone told her, it was diversified, low-cost, and historically reliable. She felt smart, responsible, and secure. Then 2022 happened. While her coworker Mark, who invested in what seemed like a much riskier mix of international funds, small-cap funds, and value stocks, barely lost any money, Sarah watched her safe, diversified portfolio drop by over 20%. She couldn't understand it. How could her diversified index fund, spread across 500 companies, perform worse than Mark's seemingly chaotic investment strategy? Sound familiar? My name is Keith, and I spend way too much time digging into the mechanics of how money actually works versus how we're told it works. If you've ever wondered why your index fund portfolio doesn't behave the way you expected, or if you've noticed that your diversified investments all seem to move in the same direction at the worst possible times, make sure to hit that subscribe button and give this video a thumbs up if it helps clarify something that's been bugging you about investing. Here's what most people don't realize about index funds, and it's something that could fundamentally change how you think about building wealth. There's a hidden rule that governs how these funds actually work, and understanding this rule is the difference between truly diversified investing and accidentally concentrating all your risk in ways that could devastate your portfolio during the moments when you need protection the most. The crazy part is, this isn't some complex financial theory that requires a PhD to understand. It's actually pretty simple math, but for reasons we'll get into, almost nobody talks about it. Before we dive into what this rule actually is, let me paint you a picture of what most people think they're getting when they buy an index fund. You walk into your financial advisor's office, or you're setting up your 401k, and they show you this beautiful chart. The S&P 500 has returned an average of about 10% per year over the long term. It includes 500 of America's largest companies across every sector of the economy: technology, healthcare, finance, consumer goods, energy, utilities. It's like owning a tiny slice of the entire American economy. When one company struggles, others thrive, and everything balances out. It's diversification in its purest form. This narrative is so compelling and so widely accepted that it's become almost religious doctrine in the personal finance world. Index funds are safe. Index funds are diversified. Index funds are the smart choice for people who don't want to gamble with their money. Just set it and forget it, they say. Time in the market beats timing the market. All of that advice is true to some extent, but there's a massive gap in the story that most people never hear about until it's too late. Here's where things get interesting, and this is where most financial education completely fails people. When you buy shares of an S&P 500 index fund, you're not actually buying an equal stake in 500 companies. That would make sense, right? If you wanted true diversification across 500 companies, you'd want to own the same dollar amount of each company. But that's not how index funds work at all. Instead, you're buying into something called market capitalization weighting. This means that the companies with the highest stock market values get the biggest portion of your investment. Let me break this down with some real numbers that will probably shock you. As of recent data, the top 10 companies in the S&P 500 represent over 30% of the entire index. The top 50 companies represent about 60% of the index. So when you think you're diversifying across 500 companies, you're actually putting more than half of your money into just 50 companies, and nearly a third of your money into just 10 companies. Apple alone represents over 7% of the S&P 500. Microsoft is about 6%. Amazon, Google, Tesla, each of these individual companies can represent 2 to 4% of your total investment. Now you might be thinking, well, Keith, these are the biggest, most successful companies in America. Isn't it reasonable that they'd represent a larger portion of the index? And that's exactly the thinking that gets people into trouble, because it reveals a fundamental misunderstanding of what diversification is supposed to accomplish. The whole point of diversification isn't to own more of the winners and less of the losers. That's stock picking. The point of diversification is to spread your risk so that no single event or trend can devastate your entire portfolio. But here's what happens when you use market cap weighting. You automatically buy more of whatever is expensive and less of whatever is cheap. When tech stocks are flying high and their market capitalizations are exploding, your index fund automatically increases your exposure to tech. When value stocks are beaten down and their market caps are shrinking, your index fund automatically decreases your exposure to value. It's like a built-in system for buying high and selling low, which is literally the opposite of what successful investors try to do. Think about this for a second. In 2000, at the height of the dot-com bubble, tech companies represented an enormous portion of the S&P 500 because their stock prices had gone to the moon. People who owned S&P 500 index funds during this time had huge concentrations in overvalued tech companies without even realizing it. When the bubble burst, their diversified portfolios got crushed because they weren't actually diversified at all. They were heavily concentrated in the most expensive sector of the market. The same thing happened in 2008 with financial companies, and it's happening again today with mega-cap tech stocks. The companies that have performed the best over the past decade now represent the largest portions of the index, which means index fund investors are more concentrated in these high-flying stocks than they've ever been before. It's like a feedback loop that increases risk precisely when risk is highest. Here's something that will probably blow your mind. During certain periods, the S&P 500 has been so concentrated in the top companies that it's actually been less diversified than some actively managed mutual funds. The very thing that's supposed to give you broad diversification can sometimes be more concentrated than funds that are actively trying to pick winners and losers. And yet we still think of index funds as the safe, diversified choice. Now you might be wondering why nobody talks about this. Why don't financial advisors explain market cap weighting when they're recommending index funds? Why don't the fund companies put big warning labels on their marketing materials explaining concentration risk? The answer is both psychological and economic, and understanding it will help you make much better decisions about your money. From a psychological standpoint, market cap weighting feels logical to most people because it mirrors how we think about success and size. We naturally assume that bigger companies deserve a bigger portion of our investment because they've proven themselves in the market. This intuitive appeal makes market cap weighting easy to sell and easy to accept without deep analysis. It doesn't require investors to think about the counterintuitive aspects of diversification or to understand why buying more of what's expensive might not be the best strategy. From an economic standpoint, the financial industry has powerful incentives to promote simple, set-and-forget solutions. Index funds are incredibly profitable for fund companies because they're cheap to manage but generate steady fee income from millions of investors. Financial advisors love them because they can recommend them to almost anyone without having to do deep analysis or customization. The entire system benefits when investors believe that buying an S&P 500 index fund is the beginning and end of smart investing. But here's what's really concerning about this whole situation. The concentration problem in index funds has gotten worse over time, not better. As markets have become more dominated by mega-cap companies, the concentration within popular indexes has increased dramatically. The top 5 companies in the S&P 500 now represent a larger portion of the index than they have in decades. This means that index fund investors today are taking on more concentration risk than index fund investors took on 20 or 30 years ago, even though they're using the exact same strategy. Let's look at some real-world examples of how this concentration risk has played out historically, because understanding the past can help us prepare for the future. In 1999, the Nasdaq 100 index was heavily weighted toward technology companies that were trading at astronomical valuations. Investors who owned Nasdaq 100 index funds thought they were getting diversified exposure to the technology sector, but they were actually concentrated in the most overvalued stocks in the most overvalued sector of the market. When the dot-com crash hit in 2000, the Nasdaq 100 fell by over 80% from its peak. That's not the kind of decline you expect from a diversified investment. During the 2008 financial crisis, the S&P 500 was heavily weighted toward financial companies like Citigroup, Bank of America, and AIG. These companies had massive market capitalizations because their stock prices had been inflated by the housing bubble. When the bubble burst, index fund investors found themselves with huge exposures to the companies that were hit hardest by the crisis. Again, their diversified investment turned out to be concentrated in exactly the wrong place at exactly the wrong time. More recently, we've seen how concentration risk can create unexpected volatility even in supposedly stable portfolios. During the tech sell-off in late 2021 and throughout 2022, S&P 500 index funds experienced much larger swings than many investors expected because so much of the index was concentrated in growth and technology companies. People who thought they owned a broad representation of the American economy actually owned portfolios that were heavily tilted toward companies that were particularly sensitive to interest rate changes and economic uncertainty. Here's something that might make you question everything you thought you knew about modern portfolio theory. The mathematical foundation for diversification assumes that you're combining assets that don't all move in the same direction at the same time. But when your index fund is heavily concentrated in companies that all benefit from the same economic trends, you're not getting the diversification benefits that the math promises. During market stress, correlations between stocks tend to approach 1, meaning they all move down together. When this happens, having 500 companies in your index doesn't provide 500 times more diversification than having one company. It provides something much closer to the diversification of owning just the largest companies. This correlation problem is particularly severe in today's market environment because so many companies depend on similar underlying factors for their success. The largest companies in the S&P 500 are predominantly growth companies that benefit from low interest rates, abundant liquidity, and consumer willingness to pay premium prices for convenience and innovation. When any of these conditions change, as they did in 2022, all of these companies tend to struggle simultaneously. Your diversified index fund turns into a correlated bet on a specific type of economic environment. The irony is that this concentration problem is partly self-reinforcing through the popularity of index funds themselves. As more money flows into market cap-weighted index funds, more buying pressure gets directed toward the largest companies, which inflates their valuations and increases their index weights even further. It's like a feedback loop where popular stocks become more popular simply because they're popular, regardless of their underlying business fundamentals or valuation metrics. This brings us to the hidden rule that changes everything about how you should think about index fund investing. Here it is, and it might seem counterintuitive at first. True diversification requires intentional imbalance. Let me explain what I mean by that, because this concept goes against almost everything you've been told about investing. When most people think about diversification, they think about balance and even distribution. They want equal amounts of different asset classes, different sectors, different geographic regions. But this kind of thinking misses the deeper purpose of diversification, which isn't to create balance for its own sake, but to create a portfolio that can weather different types of market environments. Sometimes, true diversification means intentionally overweighting the assets that are out of favor and underweighting the assets that are popular. Market cap weighting does the exact opposite of this. It automatically overweights whatever is popular and expensive while underweighting whatever is unpopular and cheap. This creates a systematic bias toward buying high and selling low, which is probably the worst possible way to build wealth over time. To achieve true diversification, you need to counteract this bias by intentionally tilting your portfolio away from market cap weights and toward strategies that don't automatically concentrate your money in whatever happens to be expensive today. Here's how this looks in practice, and I want to give you some specific strategies that you can actually implement without becoming a day trader or spending hours analyzing individual stocks. The key is to think beyond the simple S&P 500 index fund and start building a portfolio that includes different types of diversification strategies. First, consider equal weight indexing instead of market cap weighting. An equal weight S&P 500 fund owns the same dollar amount of each of the 500 companies in the index regardless of their market capitalization. This immediately reduces concentration risk because Apple doesn't get 7% of your portfolio just because it happens to be expensive. Instead, Apple gets 0.2% of your portfolio, the same as every other company in the index. Historical data shows that equal weight indexes have often outperformed market cap weighted indexes over the long term, largely because they avoid the concentration trap that we've been talking about. Second, add international diversification, but do it thoughtfully. Many investors think they're diversified internationally because they own a total stock market fund that includes some international exposure. But if you look at the actual allocation, you'll often find that international stocks represent only 10–15% of these funds. That's not meaningful diversification. Consider dedicating 20 to 40% of your equity allocation to developed international markets and emerging markets. These regions often perform well when U.S. markets struggle, and they're not dominated by the same mega-cap companies that dominate U.S. indexes. Third, include factor-based investing in your strategy. This means tilting your portfolio toward factors that have historically provided better risk-adjusted returns than market cap weighting. Value investing, for example, focuses on companies that are trading at low valuations relative to their fundamentals. Small cap investing focuses on smaller companies that don't dominate market cap weighted indexes. Both of these factors have historically outperformed over long time periods, and they provide natural diversification away from the large cap growth companies that dominate traditional index funds. Fourth, consider alternative asset classes that don't move in lockstep with stock markets. Real estate investment trusts, commodities, treasury inflation-protected securities, and even some cryptocurrency allocation can provide diversification benefits that pure stock indexing cannot. The key is to include enough of these alternative assets to matter, but not so much that they dominate your portfolio. But here's the most important part of implementing this hidden rule. You need to rebalance regularly and systematically. This is where most people fail, even when they understand the concentration problem. They set up a diversified portfolio, but then they let it drift back toward concentration as their winning positions grow larger and their losing positions shrink. Rebalancing forces you to sell what's done well and buy what's done poorly, which is exactly the opposite of what market cap weighting does. Let me give you a concrete example of how this might work. Instead of putting 100% of your stock allocation into an S&P 500 index fund, you might put 30% into an equal weight S&P 500 fund, 20% into a developed international fund, 10% into an emerging markets fund, 15% into a small cap value fund, 15% into a US value fund, and 10% into a REIT fund. This portfolio would be much more diversified than a simple S&P 500 index fund, and it would be much less likely to suffer from the concentration problems that we've been discussing. Now, I know what you're thinking. This sounds more complicated than the simple just buy an S&P 500 index fund advice that you hear everywhere. And you're right, it is more complicated. But here's the thing about investing. Simple isn't always better if simple means taking unnecessary risks or missing out on better returns. The goal isn't to make things as simple as possible. The goal is to build wealth efficiently while managing risk appropriately. The beautiful thing about this approach is that you're still using index funds and passive investing strategies. You're not trying to pick individual stocks or time the market. You're just being more thoughtful about which indexes you use and how you combine them. You're applying the hidden rule of intentional imbalance to create true diversification instead of the false diversification that comes from market cap weighting. Here's something else that most people don't realize about this concentration problem. It's getting worse, not better. As markets become more efficient and information flows more quickly, successful companies are able to grow larger and dominate their industries more completely than they could in the past. This means that market cap-weighted indexes are becoming more concentrated over time, not less. The problem that existed in 1999 and 2008 is even more severe today. Think about it this way. Amazon, Google, Apple, Microsoft, and Tesla aren't just large companies. They're companies that have achieved levels of market dominance that would have been impossible just a few decades ago. They operate in multiple industries, they have global reach, and they've created ecosystems that make it difficult for competitors to challenge them. When these companies represent huge portions of market cap-weighted indexes, you're not getting diversified exposure to the economy. You're getting concentrated exposure to a small number of dominant businesses. This concentration isn't necessarily bad from a business perspective. These companies are successful for good reasons, and they might continue to be successful for years to come. But from a portfolio diversification perspective, it's incredibly dangerous. You're essentially making a massive bet that these few companies will continue to outperform everything else in the market. That might work out, but it's not diversification, and it's not the kind of risk that most people think they're taking when they buy index funds. The psychological impact of understanding this hidden rule can't be overstated. Once you realize that your safe index fund portfolio is actually concentrated in ways you never intended, you start thinking differently about risk and return. You stop assuming that index funds automatically provide adequate diversification, and you start taking responsibility for designing a portfolio that actually meets your needs and risk tolerance. This shift in thinking often leads to better investment outcomes, not because you're making dramatic changes to your strategy, but because you're being more intentional about the risks you're taking and the returns you're targeting. You're no longer operating under the illusion that someone else has solved the diversification problem for you. You understand that true diversification requires ongoing attention and periodic adjustment. Here's what I want you to take away from this entire discussion. Index funds are still excellent investment vehicles, and passive investing is still a smart strategy for most people. But the simple narrative that you can just buy an S&P 500 index fund and call yourself diversified is incomplete and potentially dangerous. The hidden rule of intentional imbalance means that true diversification requires you to think beyond market cap weighting and beyond single country exposure. The good news is that implementing this knowledge doesn't require you to become a professional investor or to spend hours managing your portfolio every week. It just requires you to be more thoughtful about which funds you choose and how you combine them. The principles are straightforward. Reduce concentration risk, include multiple types of diversification, and rebalance regularly to maintain your target allocations. If you're currently invested entirely in market cap-weighted index funds, don't panic and don't make dramatic changes all at once. But do start thinking about how you can gradually build a more truly diversified portfolio over time. Maybe you start by adding some international exposure or some factor-based funds. Maybe you begin rebalancing more systematically. The key is to start applying the hidden rule in small, manageable steps rather than trying to overhaul everything overnight. The transformation that happens when you understand this hidden rule goes far beyond just improving your investment returns. Though better returns are certainly a nice side effect, you develop a deeper understanding of how markets work and why certain strategies succeed or fail. You become more skeptical of simple solutions to complex problems, which serves you well in all areas of financial planning. Most importantly, you take ownership of your financial future instead of delegating all the important decisions to fund companies and financial advisors who might not have your best interests at heart. So there you have it, the hidden rule of index funds that nobody explains. True diversification requires intentional imbalance. It means thinking beyond market cap weighting, beyond single country exposure, and beyond the comfortable illusion that buying one fund gives you everything you need. It's not complicated, but it does require you to be more thoughtful and more intentional about your investment strategy. Your future self will thank you for making that effort, especially during the next market crisis when your truly diversified portfolio protects your wealth while others watch their concentrated index funds get hammered. Start applying this rule today, because understanding it now could be the difference between financial security and financial disaster when it matters most.